Here's a number that should make your jaw drop. The last time $42,200 was enough to cover a 20% deposit on the median Australian home was, that's not a typo, 22 years ago. And yet in October last year, the federal government quietly changed the rules in a way that almost nobody in the media properly explained. Not a tweak, not a minor adjustment, a complete structural overhaul of who gets to buy a home in this country and when. If you're a first home buyer right now, the changes either just opened a door you thought was bolted shut, or they've made your competition significantly more fierce. Possibly both. In this video, I'm going to walk you through exactly what changed, what the data says will happen to prices, and the one thing most first home buyers are completely getting wrong about these new rules. And it's costing them. Let's set the scene. According to CoreLogic data, the national median value in Australia hit $848,858 at the end of 2025. Capital city median house prices let $1,111,588. Now, the old mental model most Australians grew up with was, save 20%, get your home loan, move in, done. Great advice for 1998. Today, a 20% deposit on a median capital city home is $222,000. If you're saving $2,000 a month, which is genuinely aggressive for most people on $80 $130K, that's 9 years of saving. 9 years. And that assumes prices don't move. They always move. So here's the tension. Demand is rising, prices are still rising, and yet a major new policy just went live that changes the equation for millions of buyers. What's actually going on? Let's get into it. On the 1st of October 2025, the expanded Australian government 5% deposit scheme went live, and it is genuinely different from anything that came before it. Here's what changed. Previous, the scheme had two big blockers. There was an income cap. Singles earning more than $125,000 a year were cut off. Couples over $200,000, gone. That knocked out a huge slice of the buyers who actually had jobs stable enough to service a mortgage. There was a cap on the number of places available each year. Tens of thousands of eligible buyers were simply locked out because the scheme ran out of spots. Both of those walls are gone. As of October 2025, the expanded scheme offers unlimited places, no cap, no lottery, no waitlist. And the income limits have been abolished entirely. Sydney, up from $900,000 to $1.5 million. Brisbane, up from $700,000 to $1 million. Melbourne, up from $800,000 to $950,000. Why does that matter? Because previously, the scheme was pointing you toward properties that didn't reflect where people actually want to live, or what the market actually looks like. With Sydney's median house sitting at around $1.475 million as of late 2025, the old $900K cap was basically useless for anyone buying a house, as opposed to an apartment in Metro Sydney. Now, at $1.5 million, you're actually in the game. The practical result for Zoe in Brisbane. She can buy a $1,000 home with a $50,000 deposit. And she doesn't need to pay lender's mortgage insurance, which, on a loan that size, would typically cost her around $30,000 to $40,000 extra. That's money she no longer has to lose just to enter the market. If you're saving $2,000 a month, the difference between saving a 5% deposit and a 20% deposit isn't small. It's 7 to 10 years of your life. Okay, so the scheme sounds great. Unlimited access, lower deposit, no LMI. Why isn't everyone celebrating? Because there's a structural tension in this policy that almost nobody in the media is talking about honestly. The scheme works by having the government guarantee up to 15% of your home loan. You put in 5%, the bank lends the rest. But the government's guarantee means the bank treats it like you put in 20%. That's why no LMI. Here's the issue. This scheme puts more buyers into the market without increasing the supply of homes. JLL's research noted something important. Property price caps in the new scheme sit very close to current median prices in several markets. Sydney's new cap is $1.5 million. Sydney's median house price is sitting at $1.475 million. That's $25,000 of headroom. What happens when you add hundreds of thousands of newly eligible buyers, all chasing the same limited pool of properties at or below the cap? Basic economics. Prices at that band go up. This isn't just theory. The ABS data for December 2025 shows that the value of first home buyer loans jumped 15.5% in a single quarter. That's not just more buyers. That's more buyers with more money, pushing harder into the market. If you're Zoe and you've been sitting on the sidelines waiting for prices to drop, this is the uncomfortable reality. The policy that was designed to help you might, in the short term, push the properties you can afford further out of reach if you don't move quickly. Let me ask you something. When you hear the government is helping first home buyers, does your gut feeling tell you that's good news or bad news for house prices? Because the answer, weirdly, is both. And how it plays out for you depends entirely on one variable. We'll get to that. There's another major development sitting right on top of this whole thing, and the timing is uncomfortable. In February 2026, the RBA hiked the cash rate by 0.25 percentage points to 3.85%. The reason? Inflationary pressures picked up in the second half of 2025, private demand grew faster than expected, and the labor market stayed tight. Now, for context, this is the shortest and most modest rate-cutting cycle in over 30 years. The RBA cut rates down to 3.60%. The market cheered, house prices responded. CoreLogic's National Home Value Index climbed 7.2% between February and November 2025. Then one hike back up to 3.85% and the picture shifts. Here's the direct impact on a buyer like Zoe. On a $950,000 loan, which is what you'd be borrowing if you bought a $1 million home with a 5% deposit, as a 0.25% rate increase adds roughly $145 to $160 a month in repayments on a variable rate loan. That doesn't sound catastrophic on its own. But remember, Zoe is already stretching to get into this market. Her borrowing capacity is reduced. The properties she could have afforded in November 2025 are fractionally less affordable in February 2026. The MFA, that's the Mortgage and Finance Association of Australia, specifically warned that the rate hike would hit first home buyers hardest, particularly those trying to access the 5% deposit scheme, because higher rates directly erode how much you can borrow. So you've got this bizarre situation. The government opens the door wider with the scheme, and the RBA nudges the door slightly back. Net effect? Still positive for access. But the window is narrower than it looked 3 months ago. Here's where it gets really interesting. Running alongside the 5% deposit scheme is something newer and more radical. The Help to Buy scheme, which went live in early 2026. The concept is shared equity. Instead of just guaranteeing your loan, the government co-purchases the property with you. They contribute up to 40% of the purchase price for a new home, or 30% for an existing home. In return, they own that share of the property. The numbers are striking. The median deposit paid by Help to Buy buyers so far has been just $29,000. That's less than most people have in their savings accounts. As of late January 2026, 64% of applicants were single buyers, and 10% were single parents. This is the scheme designed for the people who are furthest from the market. Single-income households. Renters who've never had the dual income advantage. The trade-off is obvious. You share the upside. If your property goes up in value, the government owns a share of that growth. But here's a question worth sitting with. Is 60% of a growing asset better than 100% of nothing? For someone like Zoe, or for a single parent who's been renting for 8 years, the answer is probably yes. All right, let's talk direction. CoreLogic's CodeCity HVI showed national dwelling values up 7.2% annually as of November 2025. Every major capital city recorded gains. Perth led with 2.4% monthly growth. Brisbane was up 1.7%. Sydney and Melbourne, the more rate-sensitive markets, gained 0.5% and 0.3% respectively for that month. The Catality head of research noted that the previous rate cut cycle drove a 9% surge in house prices, adding roughly $75,000 to the median value. Now, with a rate hike and the new buyer schemes firing simultaneously, The expectation from major analysts is that price growth moderates in Sydney and Melbourne. Through 2026, Brisbane, Adelaide, and Perth stay more resilient, given lower base prices and stronger population inflows. The $600 K1M band, where the schemes are most active, faces upward pressure from the flood of newly eligible buyers. One final data point to keep in mind. Listings are up nearly 40% since December 2025, according to Rain and Horn. More supply is a counterweight to price pressure, but it takes time to filter through. Here's the thing almost everyone gets backwards. The conventional wisdom right now is wait for prices to fall before you buy. It sounds prudent, it feels smart. But look at what the data actually shows. The RBA's rate-cutting cycle, from 4.3% down to 3.6%, lasted less than 6 months before being reversed. Cotality called it the shortest and most modest rate-cutting cycle in over 30 years. And in those 6 months, national house prices still climbed 7.2%. Prices in Australia have risen in 21 of the last 25 years. The two exceptions were the GFC and the 2022 rate hiking cycle, which immediately corrected itself and then surged again. The people who sat out the 2023 rate hike dip waiting for a crash missed the entire 2025 run-up. The median home added roughly $75,000 in value from February to November 2025 alone. Here's the actual risk that nobody talks about. The real cost of waiting isn't just the higher purchase price. It's the rent you keep paying while you wait. For a first home buyer paying $20,400 a month in rent in Brisbane, which is around the going rate for a 3-bedroom in the suburbs, that's $28,800 a year going to a landlord. Over 5 years of waiting for a crash that may not come, that's $144,000 that could have been mortgage repayments building equity. The uncomfortable truth is this. The 5% scheme, for all its flaws and risks, is essentially the government telling you the window is open now. The question isn't whether the scheme is perfect. It's whether waiting is actually the safer strategy, because the data says it often isn't. Right. 3 things to take away. From the 1st of October 2025, the 5% deposit scheme has unlimited places, no income caps, and dramatically higher property price caps. 1.5M in Sydney, $1M in Brisbane, $950K in Melbourne. If you've never seriously looked at this, look now. It is not the same scheme that existed 2 years ago. The RBA hiked rates in February 2026 to 3.85%, which tightens your borrowing capacity. This makes the calculation time-sensitive. Every 0.25% rate move meaningfully changes what you can borrow. Get a proper pre-approval so you know your actual number. Not the one you calculated on a website calculator 2 years ago. The Help to Buy scheme, with the government co-buying up to 40% of the purchase price, is a legitimate option for single buyers and lower deposit households. Not a last resort. The median deposit being used is $29,000. If you've got that or more and you're still renting, run the numbers on what shared equity actually looks like for you. What should you do right now, specifically? Step 1. Go to the Housing Australia website and run the eligibility check for the expanded 5% scheme. It takes about 10 minutes. Step 2. Talk to a mortgage broker, not a bank, a broker, because they can show you which lenders have capacity under the scheme right now and what your actual borrowing ceiling is at 3.85%. Step 3. Look at the Brisbane, Adelaide, and Perth markets if Sydney prices have you locked out. Brisbane's median is still 30% below Sydney's. The scheme cap is $1 million, and the city is getting $7 billion in Olympic infrastructure spend over the next few years. Now here's what I want to know, and I genuinely read every comment. If the government offered to co-buy 40% of your home, would you take it? Or does giving up that equity stake feel like too high a price? Tell me below. The conversation in the comments on this one is going to be interesting. If you want to actually understand how Australian property works, not the media version, not the social media hot takes, but the real mechanics, this channel is where I break it down. Hit subscribe, because next week I'm covering the one number that predicts where house prices are headed in any suburb better than median price ever could. and most buyers have never even heard of it.